Hi, I'm Alex Miller, and this is the Citi Institute podcast, where we explore the forces shaping finance, the global economy, and the way we live and work. In each episode, we bring you insights from thought leaders and innovators driving change, helping you stay informed, navigate challenges, and seize opportunities in a rapidly evolving world.
We're seeing that clients want money to move at the speed of data does on the internet. So to have kind of that always on access and global nature. So when you think of Citi and our large footprint across the globe, clients really see the benefit of having this instantaneous movement of money and liquidity, not having to buffer and forecast for their future payments that are needed.
From a rapidly evolving regulatory landscape to the growing potential of smart contracts, stablecoins, and the tokenization of real-world assets, it's an exciting time for the world of digital assets. For this special episode of the Citi Institute podcast, we welcome Ryan Rugg. Ryan is the head of digital assets at our world-leading transaction bank. We are going to be talking about all these timely topics. Let's get into why we're having this conversation now. Ryan, we've spoken about digital assets for many years while we're working together at Citi, but we're in a particularly interesting time when it comes to institutional digital asset adoption, because the regulatory landscape in the US in particular, but also in the rest of the world, is perhaps getting clearer. What's your take on that?
Yeah, it is a very dynamic regulatory environment right now. We have seen this new administration start digital asset subcommittees. We saw a summit recently. We've seen a crypto czar with Sachs coming in. They're really taking a much more progressive look at this space. And, we are closely monitoring it, but really focused on the safety and soundness as this kind of enters into the financial services. So we're frequently in dialogue with the regulators as well as legislators to talk about this space and making sure that, as these new technologies enter into financial services for enhancement, that we have a seat at the table. So I think, things continually happening in this space, very dynamic, exciting. I think that, 2025 will definitely be a much broader landscape than we've seen in the past.
So 2025 will be a really interesting year for institutional digital asset adoption. And we've already in Q1 seen a couple of interesting comments come out that helps at least signpost towards a more clear outlook from the US. So we've had the Trump administration's executive order earlier in the year, and just a few days ago, we had an interpretive letter out from one of the banking industry's lead regulators, the OCC. Ryan, for the audience who doesn't follow this as closely as you do, tell us a little bit about those two, the EO and the interpretive letter.
Yeah, absolutely. So for those that don't follow kind of this regulation that closely, so what Ronit is explaining is 1179 process. So any activity that a bank does in this space, they must coordinate with their regulators, OCC in this case, to make sure they get approval for this. So that has now been repealed, as well as SAB 121 from a custody standpoint, which prevented large banks from being able to custody crypto assets. That you've seen our counterparts at some of the other banks enter into this space because now that there's clarity. So one of the things that I think the ecosystem has to recognize is Citi and other banks aren't going to operate in the gray area. So if there's interpretive letters out there, if there's, different issues, like we're not going to do it until there's clear regulation that allows us to do it in a safe and sound way for our clients. So, with the US intensifying their leadership around digital assets, we expect, more of these changes to come. We're closely monitoring them, closely monitoring what it means for, our business, our strategy. Obviously, continuing to work closely with our regulators. Just because they're repealed doesn't mean that from a framework, governance, risk, reporting, that's going to change. It's just a matter of actually filing those interpretive letters. But I think, positive momentum in that direction about the changes that we're seeing that this administration is much more open to digital assets and having banks have a seat at the table, which I think is really important when we start thinking about the scalability of this technology in the future and making sure that the proper frameworks and governance and reporting and everything is like put in a safe and sound way, because that's what we want to ensure for our clients.
And of course, what's happening in the US is part of a global trend. We've seen in the EU, MICA rolled out in locations like the UAE, where I'm based. You've had regulators like VARA, digital asset specific regulator set up. Singapore's for many years led the way in this. How do you see the global non-US landscape? Are things getting a little bit clearer?
Like, as you mentioned, like with Micah, Mika, however you want to pronounce it, like out there, I would say that you've seen them leaning in a little bit, more in the past, giving that clarity for people to kind of banks and other large institutions to pave the way forward. That being said, every branch we've launched with CTS. So, right now we're live with US, UK, and Singapore, working closely with the MAS in Singapore, working closely with the FCA, as well as other regulators in the region. Because, as you start to scale, we think that having this clarity from our regulators is extremely important, and partnering with them as we start to, onboard clients.
Ryan, you snuck in a three-letter acronym there when we weren't listening carefully. CTS, Citi Token Services. Let's double click on that. Tell us what Citi Token Services are. Don't be bashful.
Thank you. So CTS stands for Citi Token Services, which is a new product we launched last September, which the thesis statement that we started with was with our clients. They wanted, multi-border, multi-bank, always on liquidity and payment. So with that, we started with, as the three branches I mentioned, US, Singapore, and UK. And again, targeting like the largest money hubs to be able to send money 24/7, 365. So if it's, 5 p.m. in New York on Friday and it's 5 a.m. in Singapore, and now you can send money. You used to have to have all these buffers of cash around the different regions, around the different branches to be able to keep money for liquidity and payments, which has now added a huge amount of efficiency to our clients. We saw a client use it last month for, Chinese New Year, when the, Singapore, branch was closed, to be able to send money to pay for US equities and margin calls. So, we started with a thesis statement for liquidity and payments, but it's really growing to, extrapolate multiple different use cases. And I think that, we're seeing that clients want money to move at the speed of data does on the internet. So to have kind of that always on access and global nature. So, when you think of Citi and our large footprint across the globe, clients really see the benefit of having this instantaneous movement of money and liquidity, not having to buffer and forecast for their future payments that are needed.
Today, what happens obviously the traditional or existing rails they move huge volumes, right? In our case, I think is it 4 trillion a day or night. So they move huge volumes. They're super robust, but they also move at human speed. They shut down at weekends. They shut down in the evening on Friday. What's blockchain, or in this case CTS, solving for? Is it simply it's giving us a second rail 24/7? What's it? How do you see this developing? Obviously, CTS has just been rolled out last year, but there's probably, in a few years' time, it'll probably lead to more. So tell us about what it solves for.
Yeah, it definitely solves, as you mentioned, for the weekend and holidays and cutoffs. But one of the unique attributes about a blockchain overall is the ability to have smart contracts. And like we all joke, it's neither smart nor a contract. It's just a series of, if this happens, then do that. So think about, you're managing money and, these 3+ branches. If my account in New York drops below 100 million, send 50 million from Singapore. So automating that whole process, making it smart money, right? So not just, and we did a POC pilot last year with a ship in a canal where, typically they have to have, letters of credit or bank guarantees to be able to pass through, and only open during traditional banking hours. This case, we took our tokenized deposits, pre-funded a smart contract. If the ship received fuel, automatically release it. So, trade is another very paper-ridden business that, looking to kind of innovate within. But the whole programmability, the smart contracts, the being able to automate, digitize this process, taking the, operation, the resource, being able to lower expenses in the future is really where we're looking to grow. So I would say CTS is just scratching the surface by enabling our clients kind of this always on. But being able to add the programmability of it, I think, is a huge, huge benefit to our clients for the future.
And let's double click a little bit on programmability. I think most of us understand what that means, but let's assume someone on this doesn't listen to this podcast doesn't really fully get what we mean, particularly in a financial services context. Give us a 101, programmability 101.
So programmability, like as I said, like a smart contract is neither smart nor a contract. It is just code that says if something happens, then do X. So you can do it for, as the example I gave in regards to sending money from branch X to branch Y. You can do it to if this, policy comes in and these conditions are met, be able to send it out. So really automating the process versus having to have like the checks and balances of humans in it to be able to actually use code as, the ability to be able to send money. So making money smart is what we call, because then it actually becomes completely digitized. So, right now with CTS, it is 24/7, but do our large corporates want to have people, if the money was received at midnight, do they want to have someone there to actually process it? No, I mean, it gets deposited in the bank account, but usually money is deposited for, the payments where if the money comes in from New York, send out to pay taxes, pay, employee salaries, whatever the case is. If this happens, then do that. So really, again, just automating these processes that have been typically very, human intense in the past.
And so far, we've talked a lot about payments because I guess that's your wheelhouse. That's the part of the bank you're in. But these topics, such as smart contracts or tokenization more broadly, they're obviously applicable across all of financial services in capital markets, in payments, and what take a sort of broad, expansive view here, Ryan. What parts of financial services do you think tokenization is really going to change the next 5 to 10 years, particularly if you get some more regulatory clarity around the world?
Yeah, within the service business that I sit in, we are focused on a very broad range of capabilities, including, issuance of digital bonds, custody, settlement of digital assets, tokenization of, what is said RWA, real world assets. So really being able to move, instantaneous movement of assets as well as liquidity and payments. So we talk about the holy grail being atomic settlement or DVP, delivery versus payment, when you're able to have money and assets settle instantaneously. So you don't have, you don't need messaging for, payments and money, and you don't need, kind of intermediaries to settle assets such as bonds or equities or money markets. So you've seen a large amount of growth, I would say, focus in this area over the last year. You have, large asset managers, like BlackRock and Fidelity and Franklin talking about this, especially about, for money markets, for liquidity purposes, to really as a growth area in this. And I think that, I joke a lot of my experience in the last 10 plus years is originally, I was focused on, tokenizing everything from mortgages, IP, bonds, equity, everything under the sun. But we always had to go back to traditional rails to settle. So, when I joined Citi a little over 2.5 years ago, focused on that cash piece of it, that, fiat leg of it, but also keeping an eye on like what's going on within the RWA, the real world assets, what is starting to be tokenized and what can we see, these efficiencies, from a digitization happening across the broader ecosystem.
Real world assets, RWAs, that's another term that's maybe a sort of whatever the blockchain equivalent of inside beltway is. We all throw it around in the blockchain world, real world assets, RWAs. And what are we talking about? We're talking about financial assets, right, that go on chain. So existing financial assets, sort of putting them on chain, aka tokenizing them. And what, just theoretically, why would we want to do it? Is it efficiency? Is it access? Is it tapping a new client base? Why take something that exists in the world today, in existing databases and legal systems, and Why put that on the blockchain rather than just going completely digitally native, starting with digitally native like Bitcoin or ETH and just focusing on crypto native products? Why take existing financial assets and put them on chain? Seems very complicated and duplicative and hard to do, no?
It's interesting you brought that up, and I guess probably should have started the conversation like breaking down the different types of digital assets because it's such a broad word, right? And as you said, it includes everything from real world assets like stocks and equities and bonds, as well as real estate, to crypto, to stable coins, to what we were talking about with CTS around tokenized deposits. It's a very broad ecosystem, and so tokenized deposits were developed to be able to instantaneous movement of payment and liquidity, across Citi's branches to have an always on infrastructure. Then you think about like money markets, tokenization of funds. Really, I would say which is tokenizing that for liquidity purposes and collateral purposes. What, for the most part, I've seen, we touched upon tokenization of trade using smart contracts with the canal and Mark and like being able to, automate that process. So taking very paper ridden businesses and being able to create what we said, smart contracts. If this happens, then do that. Then you move on to asset backed, which you're kind of alluding to, in regards to, there's repos, there's bonds, there's equities, and being able to automate that process. And again, all the lowering operational, adding efficiencies, digitizing it, even though for the most part, it's pretty efficient, but it will give more access to others and more transparency across the entire life cycle of these assets. And then moving further down the curve is like stable coins and crypto, which I would say are, newer of the assets in the last 10 plus years, where, stable coins were created because of the volatility in crypto. So I remember when I first got in this space in 2015, people were trying to use Bitcoin for like payments. Well, the volatility in it, right? It's like one day it was worth 1,000, next day it was worth like next to nothing. It wasn't a good, transfer of value for payments. So then you saw the advent of stable coins, which stable coins, I think 97% of them are linked to, US dollar, with some smaller pieces linked to crypto and algorithm. But again, one for one reserves, typically very stable, and people usually use it. Most of the flows I've seen of late is still from people going from crypto into stablecoin. So to kind of take out that vol that you see in crypto. Where crypto, we've seen large amount of growth in the last couple of years in this space, and you're starting to see institutions kind of enter it, but it's really being used for store of value. So I know that was a very long answer for RWA, but I wanted to break down a little bit of the differences in digital assets because there's so many different, flavors and types, and it's used for different reasons. And some of them are for efficiency plays, some of them for store of value, some of them are for, being able to have decentralized, movement of money without a third party involved. So kind of the reasons and the use cases that people are using them for differ across the ecosystem.
Maybe to wrap up our conversation, we could double click on the crypto point. Obviously, crypto has been something that large regulated banks in the US haven't been able to engage in for lots of regulatory reasons. So-called buy-side or asset management financial firms in the US have run ahead in some ways, done crypto ETF products and related for their clients. How do you see crypto evolving in the next few years? How are big banks going to get involved? Do you see us getting, and this is obviously a higher risk part of the business than tokenizing, say, dollars, like CTS does, moving dollars on chain. How do you see crypto evolving? What's going to be the role for large American banks in that domain?
I think it really depends on legislation. And there's two bills out there right now. We expect to see the first one, the Stable and the Genius bill, to hopefully come out in the next couple of months. So I think once we get clarity on that, it will help large enterprises, not just, banks, figure out how they're going to participate. As I mentioned earlier, we don't participate if it's gray, there's not clear regulation out there, we're just not going to participate. And that's why, focused on Citi Token Service first, and like being able to kind of automate that whole fiat side of it to have it 24/7, 365, is definitely needed in all digital asset markets, but really building that solution out on a private permission blockchain, on a private permission version of Ethereum. Because, from a safety, soundness, and scalability, that's where, from an organization standpoint, we're comfortable. As more legislation comes out and more regulatory clarity, it'll help define how, big banks participate in this space. Because there's definitely demand across the board. I would say, as you mentioned, like the exponential growth and like that we saw with the ETF market once the SEC approved it. So I expect that demand to continue as more large enterprises enter this space.
Definitely going to be an interesting year ahead for tokenization, for digital assets and crypto. The market price action has obviously been quite something in the last few months, but this technology, in a more broad sense, is going to start finding a way into the regulated industry, and it'll be a fascinating journey to watch. Ryan, thanks so much for joining us to share your insights and thoughts.
Thanks so much for having me. I really appreciate it.
The speakers' views are their own and may not necessarily reflect the views of Citi or any of its affiliates. All opinions are subject to change without notice. Neither the information provided nor any opinion expressed constitutes a solicitation for the purchase or sale of any security. The expressions of opinion are not intended to be a forecast of future events or a guarantee of future results.